Based on a recent article from Kiplinger, there are 5 keys to a retirement plan that actually holds up over time. They all start with the letter D, too, as well. Maybe that was a coincidence. Maybe they kind of forced that in. Either way, we're going to give you those 5 Ds of retirement today and break them down and explain how they are a good foundation for a retirement plan. Welcome in. Glad to have you once again on Perfect Game Retirement. Ben George with Ryan Ledden. He is the president of Black Oak Asset Management, a certified financial planner. And today, Ryan, talking about the 5 Ds of retirement planning. I don't know if you've actually gone through this. I know you talked about all the things we're talking about today, but I don't know if you've actually looked at them from perspective of all being starting with the same letter. Have you?
No, it's kind of catchy in the headline. So I was like, oh, I kind of like this topic. So we'll run with this once the article came out. So yeah, it's, hopefully people are clicking on it going, what does that mean? What are the 5 Ds that they're talking about? Yeah. But yeah, you're right. We talked about all this in different pieces, but now we're going to pull them all together.
Yeah, we'll drop that article from Kiplinger down in the show notes for you as well, so you can check that out there. But let's run through these, right? These are good, really, again, framework for a good retirement plan. And it starts with diversification, Ryan. That's the first D, probably the most obvious of the Ds we're going to talk about today. But I know people have heard about the word diversification, probably think they know it, but what is true diversification?
Yeah, I mean, I'm sure that this is not like catching headlines. Diversification is like, oh gosh, okay, yeah, I know. Have a bunch of different funds or whatever, mutual funds, and it's like, well, it's a little more to it than that. Sure, do mutual funds and ETFs, do they help with that portion of diversification? Yeah, obviously you don't want all your eggs in one basket. You don't want too many or too little individual stocks. That way you're taking on too much volatility, depending on how that company does. So you do want some diversification when it comes to that as far as your investments go. But I mean, really, diversification really comes from your different streams of income, honestly, and then how those income streams are taxed. So it's kind of you could actually go further than a 3-part diversification, but these are the main ones, kind of your investments, then the types of accounts, and going back to the types of accounts. Do you have pre-tax money? Do you have Roth money? Do you have taxable money? So do you have different accounts to pull from that are taxed differently? Our older clients stereotypically are either pension, Social Security, and pre-tax accounts. So they don't have a whole lot of tax diversification. So they stack those guaranteed income streams up. And then when they take their RMDs on top of that, every dollar is going to be taxed at whatever tax rate that they are in. So obviously, the older you get, the RMD percentages continue to go up a little bit each year. So you don't have much tax diversification at all. But if you have multiple accounts, you can pull a little bit from the pre-tax account, pull a little bit from the tax-free, and then maybe even taxable account to keep those tax rates even more favorable. Because taxable accounts, if you pull from your taxable accounts, you generally, they're more tax favorable. You're normally going to be paying long-term capital gains as long as those funds or investments have been there longer than a year, 366 days. Now, if you have bonds and fixed income in that taxable account, then those are taxed at ordinary income. So here's where the diversification of your funds, not only what you own, where do you own them? So your fixed income, you want that in your pre-tax accounts because it's taxed at ordinary income anyways. And then your stock market-based investments need to be in that taxable account because they're taxed more favorably in that account. So we get statements from people all the time, and we'll see, okay, well, why is this in this account? And it's not to poke at them or their advisor that they're working with. It's like, why are these funds or investments in this type of account? Sometimes just switching things around from a big pie standpoint, switching funds around into different accounts can be more tax favorable as well. So diversification can mean a ton of things in retirement. It is not just the investments. It's not just mutual funds or exchange traded funds. There's a lot more to that. And then even your income streams. What kind of diversification and income streams do you have? Do you have a pension? Do you have Social Security? Is it your investments? Do you have real estate? Do you have your own LLC? I mean, there's so many different things there with diversification, but that's one of the big D's there is part of retirement that we need to cover.
Yeah, that diversification, as you mentioned, covers so many different areas, not just picking stocks and bonds and mutual funds, right? It's all over your plan, and it applies to many different areas. So you want to make sure you're getting it right. So that's the first D that we're going to break down. Second one is duration. So again, this is all about making your money last as long as you do, Ryan. And look, there's different ways to approach duration, right? With the way that you invest your money and the way you save your money.
Yeah, I mean duration. We could take that in two different ways too. I mean, you could nerd out and talk about bond duration, and people are going to be like, what are you talking about? So we're going to skip that part. So, like, how long does your money have to last? That's really how long do we have? So certain investments, it's kind of it's another buzzword in our industry is like a bucketing approach. Like, do you have certain investments that are going to cover you from 1 to 3 years, and then maybe your a little bit more riskier investments are going to last, the next 4 to 5 years, and then your 10 plus are going to be over here. So that's kind of where you build out a plan. So when these long-term investments way over here are doing really well, maybe above what you're projecting, and when we project things out, we use fairly conservative rates of return. But when we do supersede those, that's where you need to be selling off some of those. So let's say you get 22% one year. I'm just making a number up. Well, I don't do a plan based off of getting 22%. So let's carve off that delta or the difference between what we plan on and what we got, and let's put that in the short-term bucket. That way, because these longer term investments, they're going to have a pullback. I'm not a pessimist. They will. It's just how much further out, how deep is that pullback going to be? So that way you're not pulling from that bucket when you need those funds if they're not doing well. So the duration is how long is that portfolio going to last? I know we had a previous show and we talked about, withdrawal rates, what percentage you can take out. That all depends on what your income needs are. It depends on what your age is. It depends on what your nest egg is. So a lot of variables there, but how long, what investments are going to kind of take you through the next few years and then long-term as well.
Well, you mentioned pullback, so let's talk about that. The third D here for this framework is downside protection. And I know, look, when the market pulls back when you're younger, no big deal, right? It's just an opportunity for most people, more than it is to be something to be worried about. But as you get closer to retirement, that obviously changes, Ryan. And I know the downside protection is a big part of what you do with your clients when you're building a plan, right?
Yeah, because obviously everybody wants a good rate of return. You want to get more consistent rates of return in retirement. When you're younger, you want a better average rate of return. But you can structure a portfolio where, you have guardrails. You have a downside and an upside. Now you can go to the extreme of potentially doing like an income annuity. That's almost like a floor where the dollar amount's not going to go below that. It's kind of guaranteed at what you put in, and then maybe you get some market returns in it, but at least what your income stream is going to be. So that's one way to prevent from or help downside protection. So again, it all depends on what your income needs are. But there's even investments like there's structured notes out there. There's buffer ETFs where it kind of eats some of the downside. So there's no such thing as a free lunch. You can't have those investments and get all the upside of the stock market. So there's a give and take relationship there, but some people are willing to give up some of the top side if they know they're not going to lose a certain amount on the downside. Again, that's going to be more for your retirees who are probably pulling money out, but it could be for some people who are just completely risk adverse and they're like, hey, I want some investment that I'm okay if I don't get the full top side, but I know I'm only going to lose a certain amount. Or if you get an annuity, certain types of annuities, they have a floor. Like whatever you put in, it's not going to go below that. So there's different ways to structure that, but especially when you get to retirement, you do want to have some of that downside protection and have certain investments that prevent a full pullback. If it is a 20 to 30 to 40% pullback, that would prevent that. Because I have clients that, they stay informed, they watch the news, and when there's a bad time in the stock market, they're like, oh gosh, the TV says the market's down this. I'm like, well, you're not down that. You're not fully invested in the stock market. So know what your portfolio is doing, not necessarily what's going on in the stock market.
All right, we're going through the 5 Ds of retirement planning. Fourth is discretionary income. So I know, Ryan, when you're trying to put together an income plan, I think most people just kind of assume, hey, I'll take my basic expenses. That's what I'm going to need to cover myself in retirement. But how do you build in that discretionary income, and how difficult is that to put together for someone that's not building a plan?
Yeah, so I just ask a lot of questions. I mean, because people have hobbies, they have interests, they have things they want to do, they want to travel, whatever it may be. So we have to build that in. Then when if I ask questions, I'm like, okay, so we build out a plan. Who needs a car next? Okay, well, this car should hopefully last 4 to 5 years. But again, we're talking about vehicles. My last truck, I loved it. It was awesome. I had it for 2 years. That thing was in the shop all the time. Oh my gosh, I got rid of it and had to get another one. So I didn't have to, but I wanted to because I was tired of taking it to the dealership all the time. So life happens. There's going to be things that pop up. If you own a home, they age themselves, and so there's going to be things that you have to purchase, whether it's an HVAC unit, a new roof, or whatever. So I try to ask as many questions as I can to build in that fluff, if you will, because that is discretionary income. Those are the things that the going out to eats and playing golf and all that stuff, hunting trips, whatever it may be. Those things we need to bake in. Now, is it an exact science? No, but we try to plan for those things to build in a buffer, especially if they like to travel. Tons of my clients love to travel. I'm like, okay, let's build that into the plan. So we do that. It's like, okay, maybe they take one big trip a year. Maybe they take one big trip every other year. So we want to build that in and make sure that way when they go on vacation, they're not worried about spending money. It's already built into the plan. They don't feel guilty about it when they do something.
All right, one last D, Ryan, is drag. So this is something that eats away at your returns over time. How do you help make sure someone doesn't have a lot of drag on their portfolio?
Yeah, and that could be a few things. Some of the investments or the funds that you may have, we take a look at them. I've gotten statements from people who are kind of vetting us to see if they want to work with us, and I'll see funds that are in there and they may perform fine, and maybe and just because they have a high expense ratio doesn't mean get rid of them. You want to see what their performance is, but we try to line those up. We try to see a certain investment. If we're like, oh wow, that's pretty high. That's well over 1% internal fees. Can we find something that's like matches up equally that kind of has the historical rates of return? Obviously, we don't know what's going to happen moving forward, but if we can find an equal one that's a fraction of the cost, then okay, that's savings right there. So just kind of know what your internal expenses are with the funds that you do use, whether they're ETFs, whether they're mutual funds. If you have annuities, know what the fee structures on that are. What kind of fee drag do you have on those? Because variable annuities tend to be higher than just kind of your income or your indexed annuities or whatever. But obviously know what you're paying your advisor. Ask that question. I tell people, go ahead and ask us. That's okay. Like, we do get paid for what we do. So be transparent and be clear about that. So, and then going back to kind of my first point from the diversification standpoint, like taxes. So if we can save you on taxes just by restructuring your portfolio, then that's less of a tax drag as well. So there's a lot of things that can add up over time to make a big difference in your portfolio. And then, this isn't necessarily a drag, but like sometimes there's adjustments to people's income. We may set out, hey, this is what their income is going to be. And maybe they're not traveling as much. They're not doing as many things as they were. So they can pull back the reins on their income, because when we do an income plan, we increase it every year to stay with inflation. So we do that, but then sometimes, January hits and they're like, hey, what we're taking out per month is fine. We don't need to increase it by 3 or 4% each year. So just kind of being aware of all those different things, they do add up in a portfolio.
All right, so 5D is kind of a fun approach. I did a little different way to kind of frame the conversation in terms of retirement planning, but these things are all super important. It's what Black Oak Asset Management does every single day, putting these all together into one plan for you that holds up over time and over the long haul, right? That's what it's all about. And if you want to run through these 5Ds for your own situation, that's what Black Oak can help you with. So get in touch. It's very easy to get on the calendar with Ryan. I know it's something a lot of people take advantage of, that free consultation to actually talk and sit down and begin talking about some of your concerns and looking through these Ds as well. But again, if you have any questions, all that contact information down in the show description for you as well. So fun way to look at it, Ryan. But that'll do it for us here on this episode. I know it's a good conversation, kind of covers a lot of different topics you do every single day. So a good one overall. We'll look forward to catching up with you on the next video.
All right, we'll see you.